Good morning and welcome to this weekly 10 minutes market update over the weekend. Of course, we had a lot of updates. The attempt on the former president of the United States, Donald Trump, and we started already seeing some sort of a reaction in the market. However, the reaction is not that big of a deal so far because, of course, and luckily he did survive the attempt. At the same time, if you look behind me here, there is the odds of Trump winning the next elections, and currently is basically over 60% according to the chart on Bloomberg. At the beginning, we saw, at least during the Asian session, we saw some uptick in commodities, at least when it comes to gold and silver. But now we're easing back down. The same thing happens also in gold, but the dollar index actually so far and until this video is released, the dollar index is slightly higher by 0.2%. So the euro is trading below 109. The British pound also below 129.60 for the time being. So on the other hand, the bond yields, of course, we saw a little bit of an uptick in the 10-year yields, or all of them, whether you're talking about 2 years, 5 years, 10 years also is up by 1%. The most is basically the 30 years is up by 1.2% so far. But I think the good thing is basically that there's no escalation, at least in the United States, and this is why the markets are still kind of stable. Even the futures are actually higher. Currently, the Dow Jones Industrial Average is up by, or the futures are up by 0.25% when it comes also to the S&P 500, and Nasdaq is adding about 0.5%, almost 0.5% so far before the opening of the European session. So there's no there's no panic in the market. There's no any kind of like panic or fear in the market that this is going to escalate. At least this is for now, and this is what's kind of good. At the same time, if you look at the fundamentals over the weekend or earlier this morning from Asia, we had a lot of economics releases from China. The GDP basically continued to slow down faster than expected. 4.7%. It was supposed to slow down from 5.3 to 5.1%. On the good side, we still have a better than expected industrial productions. We had a better than expected fixed asset investment. Unemployment rate remains stable at 5%. And finally, the retail sales slowed down to 2%. So the slowing down continues in China. However, I think this is also the first slowing down from the recent stabilization, because over the past 2 quarters, we saw at least 5.2% and also 5.3% of growth. So we're still, even with the slowing down, it is still not as bad as what everybody feared in the past, that we will see a huge slowing down in China. At the end of last week, we had another round of economic releases, and including, of course, what happened in the U.S. And one thing that we have to mention here, CPI was lower than expected. The PPI showed a different story, increasing by 0.4%. We had also the core PPI was 0.4%, double the expectations. The PPI also was up by 0.2%. But one of the most important things is the University of Michigan consumer confidence, which continued to slow down, 66 down from 68. The inflation expectations are continuing to slow down, which keeps the idea, or keeps the markets certain that the Federal Reserve will actually start cutting rates in September. I mean, if we look at the Fed fund futures in the U.S. currently, we're basically pricing in 100% chance that the Federal Reserve will actually, or not 100, 95%, that the Federal Reserve will start cutting in September. We have also fully priced in that another rate cut will happen in November, and also in December by another 25 basis points. So from now until at least January, the markets basically are pricing in 4 rate cuts from now until January, 3 this year, and 1 until the end of January. However, we still have another set of data, and one thing that we have to mention also about last week jobless claims, because of the 4th of July day off, the jobless claims were not complete, or the statistics were not complete. So that's why I think this week we should be watching for the jobless claims very carefully, because this will have, most likely, I would say, it will show a different story. As for this week, we have, of course, the main event of this week is going to be the European Central Bank decision. Expectations are pointing to no change when it comes to the interest rates, 4.25 for 4.25%, and this is what also the features are still pricing in another rate cut, but that's possibly in September, not before that. July is expected only 4% expectations for a possible rate cut. Other than that, throughout the week, we have also multiple economic releases, but not as busy as last week, at least for today. In the US, we have the Empire State Manufacturing Index. We have also a speech by the Federal Reserve Chair Powell, but we don't think that this is going to be a huge impact, depending on what he's going to say. But this is basically, he's due to speak at the Economic Club in Washington, D.C. Usually, he doesn't actually, give us more information, more than what he did in the previous testimony over the past few days. Also, we have tomorrow, we have the Canadian data or the Canadian inflation data. We have the core retail sales and the retail sales from the United States. That's another number that people need to keep an eye on, because it will show us more information about how the consumers in the US are actually doing over the past month. Expectations showing an increase by 0.1% in core retail sales, but the retail sales itself is expected to decline by 0.2%. Also, we have the inflation data from the UK, and the UK, they have one of the most stickiest inflation. However, the CPI year over year is expected to slow down to 1.9%. And this is basically what's going to help the Bank of England to maybe move towards rate cuts soon. However, the market so far is not pricing in any rate cut in at least in August, but also in September. Expectations points to 91%. And then, of course, Thursday, we have the jobs report from the UK, we have jobs report from Australia, and finally, the ECB, of course, on Thursday. On Friday, we have also retail sales from the UK and the retail sales from Canada. But that's the most important fundamentals that we will be watching. This week. From a technical point of view, the dollar index basically, after last week's move, it continues to show more and more bearish on the bearish side, more than the upside, at least from the weekly close. We did, however, close the week right at a support, which is the 104.5. And this level needs to be watched carefully this week. There's, of course, there's a possibility of a bounce after 2 weeks of consecutive declines in the US dollar. And the technical indicators are slightly becoming or getting closer to being oversold. So it would be expected to see some sort of a bounce. But the downside outlook remains as long as we continue to trade below 106. The euro this week is definitely going to be influenced by the ECB, and if the ECB decided not to commit to any more rate cuts, at least for the time being, even for the next meeting, this would give the euro another boost, especially as long as the market continue, or as long as the ECB continues to downgrade the possibilities of a gradual rate cuts over the next few meetings. This is going to give the euro a little bit of a boost or an edge over the dollar, and even possibly over the British pound. British pound last week, we had a tremendous rally, and we did actually break multiple resistance level. Now we're at the highest level since July 2023, so a year. However, the most important level now to keep an eye on is 1.3 or 1.30. That level needs to be watched very carefully. Some sort of a retracement to be expected as well. That is another thing to keep an eye on. Finally, let's talk about also gold and silver. Gold remained also very strong last week, and we did break above 2,393 at the closing of the week. We did retest that also on Friday, but the closing of last week was still positive above 2,400, and this is considered as another bullish signal for gold. Silver was not as strong as silver was not as strong as gold last week, at the end of last week, because we did lose most of the gains that was recorded on Thursday. So we did close at the end of the week around the 30.80. However, we still need to keep an eye on if we go back down towards the $30, because this is the level that markets has been defending over the past few weeks. Finally, oil, we did saw a little bit of retracement at the end of last week, but again, the most important level to keep an eye on over the next few days remains at the $84, because this is the level that is being holding for the past, or at least since the beginning of June of this year. So keep an eye on the news, keep an eye on the fundamentals that they're coming today. The more negative news coming in from the US, the more the market will actually price in sooner than expected rate cuts. And this at some point might not help the markets a lot, because this will bring fears that the possibility of a recession is actually higher than what everybody thought. So I'll see you again at the end of this week on Friday for another update. Thank you for watching.